Since June 2022, I started investing $50 every week to one of the most popular index fund ETFs, VOO. Recently, I just reached the 1-year milestone and achieved a decent rate of return of 11.39%, beating the average annualized performance of the S&P 500, which has been about 10% since 1957, when the index began covering 500 stocks. If you are interested in knowing more detail about my journey, please check out this video here where I summarized my performance over the last year. Today, I will be sharing with you the 3 valuable lessons I learned from my year-long experience of investing in index funds. Consistency is the foundation for success in any endeavor. It applies to every industry and discipline. Whether it's basketball, tennis, or any other sport, athletes achieve greatness through years of dedicated practice, training, and pushing themselves to excel in their chosen discipline. Or think about any big names in your own industry. They must have spent countless hours working, learning, accumulating experiences, and refining their skill set to become the people others look up to. That's the power of consistency, and it is not just limited to the professional world. It holds true in our daily lives as well. We drive every day to become proficient in handling different traffic situations, and we cook regularly to gradually learn how to prepare tasty and complex dishes. When it comes to investing, consistency is equally crucial. When I first started investing in the stock market, I experimented with various strategies. I tried buying and holding stocks for long periods, but when the market took a downturn, I became panicked and abandoned my plan. I tried to leverage ETFs. I tried investing in well-known companies and unfamiliar small firms. Unfortunately, I ended up losing money every time. It took me a few years to finally realize the importance of being consistent in the stock market. Frequently changing the investment plan won't lead me to success. Instead, all I need to do is sticking with a good plan and waiting for time to work its magic. My index fund ETF challenge is the perfect example. At first, I forgot to purchase my weekly shares on time a couple of times. After 3 or 4 months, it became a routine and brought discipline and concentration to my investment style. Regardless of the market's performance in a given week, I had to invest my $50 without fail. This unchanging rule made my investing life incredibly consistent throughout the whole year. Since I had to follow the same strategy week after week, I became more focused on my shares and investment plan. It prevented me from being swayed by numerous distracting investment strategies. After all, I only need one solid investment strategy to be profitable in the market. Risk and uncertainty are inherent aspects that everyone dislikes. Let me ask you a simple question. Your boss offers you 2 job options. Option 1 guarantees a yearly salary of $100,000, while option 2 is working for a year with a 50% chance of earning nothing and a 50% chance of earning $200,000. Which one would you choose? Most of us would likely opt for the first option, as it provides a safer and a more predictable outcome. We tend to shy away from situations that involve significant risk and uncertainty. However, investing is exactly the opposite. Even investing genius like Warren Buffett, who is considered one of the greatest investors in history, couldn't predict the market 100% right. Buffett actually experienced losses in 7 out of the past 43 years. The market is unpredictable, always accompanied by risk and uncertainty. When we invest, we venture into territory that contradicts our natural inclination. We must train ourselves to embrace the pressures that come with risk and uncertainty. Developing emotional resilience takes time and effort. Reflecting on my own journey, I recall feeling uneasy about buying my weekly shares when the market was in decline. I feared that price would plunge further and that buying at the current price might not be a wise choice. Similarly, during periods of significant market rebounds, I hesitated to purchase shares because I felt the current price were too high. Active trading requires navigating the emotion of fear and greed. It's a process that gradually enables us to become more comfortable with what we inherently dislike. Through this year-long challenge, I've noticed a significant improvement in my ability to handle emotional fluctuations. For this reason, I would encourage you to embark on your own investment journey as soon as possible. The actual amount of spare money you currently have is not crucial. You can start with even just $1 per week. What truly matters is taking that initial step towards personal growth and creating opportunities to train a strong investing mentality for yourself. If you are not comfortable investing $10 in the bear market now, picture a future where you have $1 million to invest. Will you suddenly feel confident about investing entire $1 million in a bear market? It's highly unlikely. Therefore, building emotional resilience is important and starting from now. Now let's talk about the third lesson I learned after investing VOO for a year. That is, how much you invest matters. It may seem contradictory to what I previously mentioned, but let me clarify the distinction. Earlier, I emphasized starting with a small amount like $1, $10, or $100 per week to develop a resilient mentality and become more comfortable with risk. This gradual progression is a learning curve that takes time to navigate. Therefore, I would recommend you to start ASAP. But now in this section, we will focus on the ultimate goal of investing, making money. To achieve substantial profit or meet your own investment target, a significant capital infusion is necessary. In my year-long index fund ETF challenge, I invested $2,600, which yielded a profit of approximately $300. In terms of rate of return, that's 11.39%. But if we look at the actual amount, that's just $300. Let's be honest, how many people would feel excited about making $300 throughout a year? Most people definitely aim at something way more than that. Assuming you can achieve a similar rate of return, if you target at earning $3,000 annually, it would require an investment of $26,000. If your ambition is $30,000, you will need to invest $60,000. That's a lot of money. Another example, if you could only invest $10 per week, that's $520 a year. Over a decade, your total investment would amount to $5,200. Let's assume you double your money during the time period. You would end up making profit of about $5,000. Although $5,000 is undoubtedly a significant sum, its accumulation over 10 years might not satisfy the expectations of most investors because it is only $500 per year. The brutal reality is, while mental preparedness for market fluctuation is very important, financial readiness plays a pivotal role in determining the scale of your potential returns. So how can we find additional funds for investment? The solution is simple: making more money or saving more money to support your investment portfolio. For many people, quickly finding a way to increase their income is difficult. A more practical approach will be saving as much as possible. Keep in mind, if you are struggling to meet essential needs like buying groceries, paying bills, supporting your family, or if you can barely set aside funds for emergency, it is wise to avoid investing due to associated risks. However, if your financial situation allows for it, I want to share an insightful quote from Warren Buffett. Do not save what left after spending, but spend what left after saving. By adhering to this principle, you can gradually accumulate more funds for investment. The more money we can save, the more we can invest, the greater the likelihood of attaining higher returns. When the market skyrockets, we ride the wave, and when it dips, we seize the opportunity to acquire more shares at a lower price, positioning ourselves favorably for the next upward swing. Therefore, if you have an ambitious investment target, get an aggressive saving plan, conduct thorough research, identify a solid investment strategy, and carefully invest your money. That's all the lessons I learned over the last year. If you find this video helpful, please hit the like button, leave your comments below, and consider subscribing to my channel. I'll see you next time.